Hello, my name is Candace Sherrar, and I'm the Marketing and Communications Manager for SVB Asset Management, commonly referred to as SAM. And I wanted to welcome all of you to the discussion this morning and give a special warm welcome to clients in the SAM Access strategy. This is our inaugural event for clients in the strategy, and investment professionals will review the economic events of the recently completed third quarter of 2024, provide their thoughts on potential monetary policy in the current rate cycle, and share some strategy considerations for enhancing the objectives of safety, liquidity, and yield within the portfolios. I'd like to introduce the presenters sharing insights today. Travis Dugan is Managing Director, Head of Portfolio Management, and leads SAM's team of portfolio managers who create and manage customized separate account portfolios for clients. Travis has over 25 years of experience in fixed income investments and is based in San Francisco. Steve Johnson is a member of SAM's portfolio management team and is responsible for structuring, analyzing, and monitoring fixed income portfolios for SAM clients. Steve has more than a decade of experience managing fixed income investments and is based in Boston. A couple housekeeping items today before we get started. All lines have been placed on mute to prevent background noise. Both the chat and Q&A functions have been disabled. Speakers will address questions submitted on the pre-event registration form, time permitting, and we will send a link to the recording after the webinar. Just to note that the information presented today should not be viewed as investment or other advice. Views expressed are as of the date of this presentation and subject to change. Please contact your liquidity advisor for more information. And now over to Travis with the agenda of today's topics and to kick off the discussion.
Thanks, Candace. All right, we'll go ahead and jump right into it. Today, I'll go over our agenda with some key takeaways and that we look to cover. I'll be covering the economic data, and Steve will be covering the Federal Reserve and the yield curve and rates data. So from a high level, starting with the economic data, we've seen the labor market show signs of slowing, and it's continuing to slow down, although from a pretty strong position. Inflation has significantly moderated over the last few years. It got to a pretty high peak during COVID and has come down a lot and continues to go down towards the Fed's target of 2%. We're there. This last mile there could be a little bit tougher, but the Fed's confident that we're going to get there. Speaking to the Federal Reserve, we know last week the Federal Reserve lowered the policy rate by 50 basis points at their September meeting. The market is actually expecting that the Fed, over the next two meetings between November and December, the market expects that there will be three more cuts of 25 basis points each. And that would imply that either the November meeting or the December meeting, there could be another 50 basis point cut. The Fed's focused on the labor market and they're focused on the economy, and they're a little bit less focused on inflation right now. They feel they've really won the battle on inflation, so the shift has moved to the labor market, and we'll discuss that a little bit more in the next slides. Also, the yield curve and rates, we've seen front-end Treasury yields move significantly lower already, and this is really the market reacting to not only what the Fed has done so far, but what the Fed is expected to do in the coming meetings. Money market fund yields, as most people have seen, have already started to move lower. Money fund yields move pretty closely in step with the Fed funds rate. So we expect money fund rates to continue to go lower after each Fed cut. We, in our strategy, position our portfolios to lock in yields. We really see the value in adding some duration to portfolios to lock in yields for longer than what the money funds will get you in your returns. We remain tactically long our benchmarks. We continue to position portfolios to maximize the yield, but we're very careful about when we do it. There's a lot of volatility in the market, so sometimes we're adding more duration, other times we're being patient and waiting for better entry points. On the next slide, and one more slide after that, we'll start with unemployment. Unemployment's been on the rise. You can see on the left chart on the upper side, we've seen unemployment rise. It's come from very low levels. Unemployment was down around 3.4%, which is extremely low, and it's only up to 4.2%, which is still very low. The market, the Fed will tell you the market is still strong, the labor market is still strong, but what they're looking at is this recent trajectory up. The move from 3.4 to 4.2% happen pretty quickly. And so this is giving the Fed some concern. On this chart on the right, you can see average hourly earnings. So this is how much employers have to pay to bring in new employees, how much they have to pay to retain employees. When the jobs market was super tight coming out of COVID, employers were having to pay more money to attract workers. Now that pressure has come down. The jobs market has definitely been more balanced lately, and because of that, employers are not having to pay up as much to keep employees and to bring in new employees. So that's a good sign as far as inflation goes. Is that wages have been moderating. They're still positive, but they're moderating. Then on the slide down the bottom here, we take a look at jobless claims, both the initial claims and the continuing claims. And I will say with this data, it comes out weekly and it can be kind of volatile because it comes out so frequently. There's things that can impact the week-to-week numbers, such as holidays, such as extreme weather, which we've obviously seen, unfortunately, a lot of that recently. And then as well as big things like union strikes, which we're also seeing. So we like to look at, in some ways, when we parse the data, we like to look at the 4-week moving average because that kind of smooths out some of the data and kind of gives us a better picture for what's really happening. And now the trend so far for the continuing claims, you can see that light blue line has been moving higher at a pretty moderate pace, but the trend definitely is up. So more people are filing for jobless claims, and that's a sign that the labor market is starting to weaken. We haven't seen the trend, looking at that dark blue line, we haven't seen the trend as pronounced in the initial claims market. So that's something that we're continuing to watch. Later this week, we're going to get some non-farm payrolls on Friday. We'll also get a new read on unemployment rate on Friday. Those numbers will be very closely watched by the market. On the next slide, we see that this is the second part of the Fed's dual mandate. The first part is to have a healthy jobs market, a healthy economy. The second part is to maintain low inflation. And you can see from this chart, there was a mountainous spike of inflation. And that came really during COVID. And that came because the global pandemic shut down global economies. And so factories were closed, shipping had stopped. There was a huge disruption in the supply chain, and that caused prices for everything to go up to unreasonable levels, unsustainable levels. And this spike in inflation is really what caused the Fed to move from 0% up to 5.25%. They really had to cut off this inflation, bring it back down. Inflation is not healthy for an economy, and so granted, we went through a non-normal situation with a pandemic. We don't see that pandemics happening very often at all. So this was really a situation that the Fed hadn't experienced before. But what as they rose rates, they really slowed down inflation. And you can see here by multiple measures, the headline, the core takes out the energy and some of the volatile components, as well as PCE, which is another read of inflation. And that's the actual PCE is what the Fed looks at when they're looking at inflation. But by all measures, you can see that inflation has come down. And it's not down. The Fed's long-term target is 2.0%. So we're not there yet. But what the Fed will say and what they've been saying after their meetings and during their when the Fed speakers come on to speak in interviews, they've said that the trajectory is in the right direction. And because it's in the right direction, they're less concerned with killing inflation. They feel like they've been successful in bringing it down and that it will continue to come down, especially as the jobs market continues to weaken. So the Fed's really more focused on jobs right now, and that's really where our focus is as well. On the next slide, take a look just kind of drill into the components of inflation. And right here in this chart, this is from Bloomberg, and you can see some of the components of inflation. You've got food, you've got energy, core goods, and then you've got core services. And what really stands out here is the core services. Those yellow bars are services, and services inflation hasn't come down nearly as much as food, energy, and core goods. In fact, some of those other measures are actually negative and have helped to bring down overall inflation. What we're looking at and what the Fed is looking at is for this, we need to see that services component come down, not a lot more. I mean, we're still between 2.5% to 3%, depending on the measure, but it just needs to continue to come down marginally so that we can really get to the 2% target. And we expect that that's going to happen. The Fed also expects that's going to happen. The Fed has a great deal of confidence in that happening. So we'll continue to watch this. We look at inflation in all different measures, and this is just one way to drill down and really understand the components of it. Moving to the next slide. Everyone likes to talk about mortgage rates. Either you own a house or you might want to buy a house, and this is really pertinent to all of us. And so, we've seen housing prices continue to rise. And there's a lot of things going on here. One is you can see from the bottom chart, the pink line, that's 30-year mortgage rates. That's usually people they get a fixed rate mortgage to buy a house. Mortgage rates, because the Fed had raised rates, longer term rates had also gone up because longer term rates are more impacted by inflation expectations. And because of that, houses became less affordable because it was more expensive to get a loan. On top of that, those homeowners who got loans and bought houses back when rates were really low, those of you who have a 3% or less than 4% mortgage rate, you're not inclined to want to lose that mortgage rate. That's cheap borrowing. So all of those people who have houses they're less likely to sell and then move up to a nicer house or sell to move up to a better area. They're keeping those mortgages and they're keeping their houses because those rates are so low. And because we're seeing less turnover, that means that's contributed to less supply of existing houses available for sale. And on top of that, you've got builders who create the new supply. They've been more cautious because coming out of COVID, the economy was slower. Also, their borrowing costs are higher too. So the builders have been, reluctant to borrow money to build a lot of new houses because they see that houses are still not with prices being high, mortgage rates being high, they're less affordable. And I'd like to say those rates are coming down. We've seen them come down some. We don't think they're going to come back down, to where they were when we had the 3% mortgages, but we'd like to see some normalization of the market. If the Fed's successful in, bringing down their policy rate and avoiding a recession, then I think that might stimulate builders to build more. It could probably stimulate, homeowners to be more willing to trade up for another house as rates come down a little bit more for mortgages. I'm going to go ahead and stop there and pass it over to Steve.
Yeah, thanks, Travis. Great background to start to talk about, the Federal Reserve. In this section, we've got a little bit on the September meeting. They're a little bit on the summary of economic projections, the market's expectations, and then a look at history of Fed rate cutting cycles. All that just hopefully to provide additional information around kind of what Travis covered and how the Fed's going to respond or has responded historically and what the market's expecting. For this September meeting, looking back 2 weeks ago now, first and foremost, they cut 50 basis points. There was a debate that seemed to go away around whether they would actually go 50 basis points or not that kind of came back to life leading up to this meeting. I would say it was the first meeting in quite a while where the market was very torn and didn't have clear direction from the Fed as to the magnitude of the cut that was coming. We knew cuts were coming, but whether it was 25 or 50, was a bit unclear leading up to the meeting. That's the first takeaway. Obviously, the Fed laid the groundwork in their projections for this to be the first in a series of rate cuts. I think another key takeaway is what's written in the top right, where Jerome Powell explicitly stated, we cut 50 today. We think that's the right way to start this rate cutting cycle, but don't expect 50 at each meeting, going forward. I think him explicitly stating that shows that 25 is likely kind of the pace of travel from here. We'll see, if more of the trends that Travis covered continue, that could change. But generally speaking, that's kind of the baseline expectation for meetings from here on out or cuts from here on out. I would also just add the top bullet point in the very last section here, and we'll get into the summary of economic projections or the SEP. But Powell did note during the press conference at this September meeting, nothing in the projections suggests the Fed is in a rush. The market pricing, I'm jumping ahead here, is in a bit of a rush, but at least in the Fed's own words, this rate cutting cycle will be one that plays out kind of in a gradual and orderly process if things continue as they are today. On the next slide, digging one level deeper into the September meeting. For a bit of background, there's 8 Fed meetings a year. Every other Fed meeting, so it's March, June, September, December, we get a look at the Fed's summary of economic projections. We're showing that in the top left of slide 12 here. The way this works is there's 19 members of the Fed. They all submit individual projections, and then the distribution, but also the median of those projections gets released to the market. The market really cues in on the current projections, of course, but partly how those projections have changed from, in this case, the June Fed meeting, and to kind of cue into how the recent period economic data has changed the Fed's thinking. So we're showing, in parentheses, the June projection, and then to the left of that, the projection from September. We get these for the upcoming 3 years. So really the story that kind of, I think, is shown in these projections this time around is the labor market has changed. Travis covered the actual data, but in the Fed's own mind, unemployment is going to be higher to end this year. You can see they revised up their expectations for unemployment from 4% in June up to 4.4% by the end of 2024. The labor market will also be weaker next year by 0.2% and weaker versus June also in 2026. So the labor market has weakened, warranting a policy response, by the way. Inflation, the good news, is a bit more under control. The Fed has a bit more confidence around, as Travis alluded to, the trajectory for inflation and the fact it's headed back to their target. You can see they revised down their core PCE inflation targets over the next 3 years, reaching 2%, their official target, by 2026. And all of that, the not great news with unemployment, the good news with inflation, allowing the Fed to start cutting rates, certainly, but also to drop rates quicker than they projected in June. So you can see the projections show the Fed expects to end this year with a policy rate of 4.4%. That's well down from what they said in June, when it was only going to be one cut in aggregate, in the Fed's aggregate thinking, and lowering rates to 3.4% next year versus, the 4.1% that they said in June. So little bit weaker labor market, better on the inflation front. Fed has the ability to drop rates, quicker than previously expected to hopefully continue this soft landing. On the next slide, that's the Fed's thinking, turning a little bit to the market's expectations. I mentioned the Fed's not in a rush. What we're showing here are Fed Fund futures expectations for the policy rate. This is the market's expectation in purple for where the policy rate will be from the November meeting all the way out to the December meeting of 2025. We translate that purple line into the number of 25 basis point cuts that the futures market is implying. That's in light blue. So for example, by December of 2024, the market expects there will be 3 more, Travis said this, but 75 basis points or 3 more 25 basis point cuts by the Fed. And then we also are showing you in dark blue, translating the Fed summary of economic projections, which we just looked at, into 25 basis point cuts. And so you can see the juxtaposition where the market is and where the Fed is in terms of number of cuts by kind of these key dates. So simply put, the market's in a rush. The market thinks the Fed's going to take policy down to 3% by the June meeting of next year. So that's, as you can see in the market's eyes, almost 7 25 basis point cuts over the course of now till June. The Fed is not, 1, in a rush, but 2, in agreement with that pace of cuts, at least at this point. So you can see the Fed, if next year plays out with 25 each quarter, it'll be about 4 cuts in the Fed's eyes by June of next year. Again, a big juxtaposition, but the market's in a rush, and certainly the Fed in their September projection showed that they aren't at this point. And then lastly, on the Fed, just I think as we think about this upcoming rate cutting cycle that's already started, maybe it's not upcoming anymore. Candace, you can go on one more, please. I think it's helpful to look back at history. And so there's a lot on this slide, but just focusing on the far right, what we're showing here are the last 8 Fed cutting cycles, really pausing and cutting cycles, going back to the 80s. So we show the amount of time, this is the second to left column, the amount of time the Fed was on hold. The second from the right column, the number of cuts the Fed delivered in the first year after they stopped hiking. And in the far right column, the total number in basis points of easing or cuts the Fed delivered over the entire cutting cycle. So I think the median at the very bottom is really helpful. On average, or the median amount of time the Fed was on hold, going back to the 80s, was 7 months. This time around, the Fed was on hold, they're not anymore, for 14 months. So double, the median amount of time. They also cut almost 1%, 97 basis points, in the first 12 months after they stopped hiking historically. They didn't cut at all, as you guys know, because they were on hold for 14 months this time around. And so far, they've delivered 50 basis points of cuts. The median historically is 425 basis points, which if history repeated and this median held true, the policy rate would be down in the low 1% range when it's all said and done this time around. So I think this bears just paying attention to. A lot of these Fed rate cutting cycles ended in hard landings. That's not where the US economy is today. But if we get there, if we see more labor market weakness and the economy starts to slow significantly, I think it's helpful just to know kind of the general precedents that history tells us as to where policy could end up and how much the Fed could have to not just normalize policy, but ultimately ease policy to help stave off that hard landing. Next, we thought maybe just covering a little bit on the yield environment, given the economic backdrop, the Fed backdrop, turning to a little bit of the yield curve and how that's changed as a result of those first two inputs would be helpful. From a yield standpoint, Travis alluded to this in his opener. We've seen a lot of volatility in Treasury yields. This slide shows you one-year Treasury yields, two-year Treasury yields, and then the Fed fund policy rate. I'll really just cue in on kind of the period the Fed's been on hold and then has cut. So really going back to July of last year. While the Fed was on hold and hadn't made any changes, you can see yields swung all over the place. Travis alluded to us trying to be patient, add duration, and add securities when the yields make sense. This gives us lots of opportunity to do that, kind of simply put, because of the volatility. For example, to start 2024, the market was convinced the Fed was going to cut up to 6 times in 2024, starting in March, so over 7 months ago. That didn't materialize. Inflation kind of didn't cooperate, and yields moved well back up into the second and third quarter of this year, presenting a buying opportunity. And then, as you can see, kind of on the far right of this chart, yields have really just plummeted since the market's become sure and the Fed has confirmed that rate cuts are here and more are coming. And so not as great of a buying opportunity. Certainly, we still think makes sense to do it. But this volatility that we've had this year as the Fed's been on hold hasn't moved their policy rate, but bond yields have moved with market expectations. It's presented a decent amount of buying opportunity at a 23-year high for yields, by the way. So decent all-in level to purchase securities. On the next slide, just 2 more slides. While the Fed has started their rate cutting cycle, money fund yields have been, I would say, just the most reactive so far. And Candace, yep, just this one. What we've seen, just focusing on the far right side of this slide, is that the Fed delivered their 50 basis point cut in September. Government money market fund yields reset very quickly. So a money fund yield was at about 5.2% before September 18th, when the Fed first cut. We've seen that yield move down to 4.83, or kind of the low 4.8% range. So that has incorporated most of the rate cut. As you can see over the full history of this chart, that's generally what we see for money funds: a high sensitivity, a high correlation to where the Fed takes their policy rate. This is one reason why Travis and I both kind of talked about it. At this point in the rate cycle, we like getting funds out the curve so that, for lack of a better way to say it, you're not taking the full brunt of a rate cut by just sitting in a government money market fund, which is very sensitive to rate cuts. You own some securities out the curve with fixed coupons that are yielding what they're yielding until they mature, as opposed to a money fund, which really kind of floats, so to speak, with the Fed policy rate. Turning to bond yields specifically, and this is my last slide. it's been a big change. So we showed it kind of in aggregate over a longer time period 2 slides ago. What we're showing here is just the Treasury yield curve out to 3 years, so a little bit longer duration, yields on the y-axis, and then different time periods and how the yield curve has shifted so far this year. So end of first quarter in light blue, end of second quarter, and then basically the end of the third quarter, September 27th in dark blue. And I think it's way too simply put, but 5% is kind of a thing of the past at this point. We were able to buy, you can see back in the first and second quarter, you were able to buy securities, treasuries yielding 5% well into the 1-year point of the curve. There were times where you could also get 5% at the 2-year point of the curve this year. That has kind of come and gone. 4%, even if you're looking at the yield curve today, a little bit harder to get, even staying inside a year. And so this is just the trend you typically see at the end of a Fed cycle, where Fed's taking its policy rate lower, the market's expecting more and more cuts, so bond yields are moving in advance. Again, one reason why we like getting funds out the curve right now, because you're participating in this rally if you own some securities further out the curve. So I'll stop there. And Candace, hand it back to you.
Thank you. Yes, we just wanted to remind everybody that we have some great professional insights available on the SVB website, both our monthly market insights as well as our quarterly economic report. I also do want to let clients know that the portfolio review decks will be sent out to them by the end of this week, and much of this information will be included within their review deck. We do have time maybe for 1 or 2 questions that did come in that I can pose to our insightful experts. The first one is, what is the expected impact of November's elections on the Fed's November meeting and decision, and won't the decision be seen as political if they cut? Not sure who wants to take that one.
I'll take that one. Thanks, Candace. That's a great question, and one that we do frankly hear a lot about. But what I'll say is that the Fed will tell you, and Chairman Powell specifically will say that he's been through several elections, and as he's been the Fed, head of the Fed, and he'll tell you that they are not political at all. The Fed is very focused on their mandate. The Fed is independent for a reason. They were set up to be independent, and we really believe that they are independent. They are going to look at the data. They're going to look at the jobs data. That's what they're more focused on now. They're going to look at the inflation data. They don't care about the election. They're not political. I believe truly that they're not political at all, and that they will, if they need to cut 50 basis points in November to support the economy, they're going to do it. They're not going to wait because it's an election month. It's every meeting is live for the Fed at this point, and we fully expect that they will cut. Whether they cut 25 or 50 is the question, but we don't think they're impacted by politics at all.
Great. And maybe we have time for one more. What upcoming economic data are you focused on, and what would it look like to make the Fed cut 50 basis points again?
That's another great question, and one that we're constantly trying to figure out. And in what we're looking at and what the market is looking at, really, it's the jobs data. And actually, this Friday, so a few days from now, we get the monthly non-farm payrolls data. That is probably the most important data point for the Fed, as well as we get the unemployment data. And so those 2 data points are very important to the Fed. They're really going to drive their decisions. I will say that data is going to come out. It comes out monthly. There'll be another print of that data November 1st, and the Fed meeting is November 7th. So we get the benefit of seeing that data twice before the next meeting. And if that data comes in really soft, or if it comes in negative for the jobs data, like that will really give the Fed the fuel to cut rates by 50. There's a lot of debate right now as to, different Fed governors are saying 25 versus 50. But, if we get really soft, since we know the Fed has been focused on jobs more than inflation, soft non-farm payrolls will get them likely to cut by 50 in November.
Great. Thank you so much. I believe that's all we have time for today, which will wrap up this event, which we hope was informative and assists you with your cash management program. And we sincerely appreciate you spending this time with us today, and be on the lookout for a recording of what you just heard. And feel free to reach out to the liquidity account management team with any questions. Thank you all so much.